For 5 years, one man made one promise about Bitcoin. He said it publicly, repeatedly, and without exception. Never sell. That man is Michael Saylor. And last week, he broke that promise. On June 1, 2026, Strategy, the company formerly known as MicroStrategy, filed an 8K document with the SEC revealing it had sold 32 Bitcoin between May 26 and May 31. The sale raised approximately $2.5 million. Now, that number sounds small. And mathematically? It is. But the market didn't care about the math. Bitcoin fell below $70,000 for the first time since April. Crypto stocks across the board took a hit. And a question that billions of dollars of institutional money are now asking is this: is the Bitcoin bull story, the one Saylor built, still intact? I'm Michael Carter. This is CapitalClarion. Let's break this down. To understand why this sale rattled markets so much, you need to understand what Strategy actually is and what Michael Saylor turned it into. Strategy started as a software company, a fairly ordinary one. But in 2020, Saylor made one of the boldest corporate bets in modern financial history. He began converting the company's cash reserves into Bitcoin. Not a little bit. Aggressively. He issued stock. He issued debt. He borrowed money at low interest rates and poured it all into Bitcoin. By early June 2026, Strategy held 843,706 Bitcoin. Let that sink in. 843,000 Bitcoin. That's roughly 4% of all Bitcoin that will ever exist. At current prices, that stake is worth close to $59 billion. Saylor didn't just buy Bitcoin. He became the loudest voice for Bitcoin as a treasury asset. He said Bitcoin was digital gold. He called it the hardest money ever created. And he made one pledge that became his brand identity: he would never sell. In February of 2026, just 4 months before this sale, Saylor was on CNBC's Squawk Box. Anchor Andrew Ross Sorkin pressed him directly, "What if Bitcoin falls and stays down for years?" Saylor's answer was blunt: "We're not going to be selling, we're going to be buying every quarter, forever." In February 2025, when Bitcoin dipped below $85,000, he posted on X, "Sell a kidney if you must, but keep the Bitcoin." That was the brand. That was the story. Never sell wasn't just a strategy, it was the product. Investors bought MSTR stock because they believed the company would hold through anything. So when that filing dropped on June 1, even 32 coins, even $2.5 million, the market heard something loud. Now let's be precise about what actually happened, because the details matter. Between May 26 and May 31, Strategy sold 32 Bitcoin at an average price of $77,135 per coin. Total proceeds, approximately $2.5 million. The stated purpose was to fund dividend payments on what's called the STRC perpetual preferred stock. When you issue preferred shares to investors, you owe them regular cash distributions. It's a fixed obligation. You have to pay it. Strategy's preferred stock program has created roughly $1.5 billion in annual dividend obligations. To fund those, the company has a few options: sell common stock, issue more preferred shares, use cash on hand, or, apparently now, sell a small amount of Bitcoin. This was the first time since December 2022 that Strategy sold Bitcoin for any reason other than a tax maneuver. That 2022 sale was different. They sold 704 coins near the cycle bottom, then bought back 810 2 days later. It was widely read as tax loss harvesting, not a genuine policy change. This sale is different. There was no repurchase. It was financial plumbing, selling Bitcoin to fund a liability. Now, to be absolutely fair to the bulls here, 32 Bitcoin is 0.0038% of Strategy's total holdings. That is not a typo. 0.0038%. The company still holds $59 billion worth of Bitcoin. The sale is economically irrelevant. 2 Wall Street analysts went on record saying exactly that. The transaction is immaterial, it's tactical, it doesn't signal a fundamental shift. But a third analyst suggested something larger was at play. And the market agreed with the third analyst. Because here's what investors were really reacting to: not the 32 coins, but the precedent. Once you sell to fund a liability, the question becomes, how many more liabilities are coming? And will there be more sales? There's a more bearish read on this situation that you need to understand, because it's circulating on Wall Street and it's moving money. It goes like this: Strategy's model depends on Bitcoin going up. When Bitcoin goes up, the company's net asset value rises, its stock price rises, and it can issue new shares at a premium to raise cash to buy more Bitcoin. It's a flywheel. But when Bitcoin goes down, as it has since its all-time high near $110,000 in November 2025, the flywheel slows down. Strategy reported a $12.5 billion net loss in Q1 2026, its third consecutive quarterly loss. The losses are largely unrealized, on paper, but they're real enough to matter. The concern is what some analysts are calling a potential death spiral. Falling Bitcoin prices increase unrealized losses, which pressures the stock price, which makes it harder to raise capital, which makes it harder to fund obligations, which may force more Bitcoin sales, which pushes Bitcoin prices down further. Now, to be clear, Strategy is not Luna. This is not a collapse scenario in the near term. The company has two real buffers. First, most of its debt is long-term and doesn't have short-term liquidation triggers. Second, it still has a traditional software business generating cash flow. But the market is watching very carefully. And the moment Saylor's never sell policy cracked, even by 32 coins, the psychological protection that story provided cracked with it. Now, Strategy's sale didn't happen in a vacuum. It hit a market that was already bleeding. Let's talk about the Bitcoin ETF situation, because it's historic, and not in a good way. When spot Bitcoin ETFs launched in the United States in January 2024, they became one of the fastest-growing financial products in history. BlackRock's iShares Bitcoin Trust, known as IBIT, attracted tens of billions of dollars in its first year. The narrative was clear. Institutional money was finally coming to Bitcoin through regulated, accessible vehicles. That narrative has been tested hard in recent weeks. Through late May 2026, U.S. spot Bitcoin ETFs recorded 10 consecutive trading days of net outflows, the longest such streak since these products launched. Over that run, nearly $3 billion left the complex. The damage was spread across the entire ETF market. BlackRock's IBIT absorbed the heaviest hits. On May 28 alone, IBIT lost $527.84 million in a single session, just barely missing its all-time record outflow of $528.3 million. Fidelity's FBTC shed $60 million that same day. Grayscale's GBTC lost $104 million. The full complex of 11 U.S. Bitcoin ETFs lost $733 million in a single trading session on May 28. Here's one of the most significant data points of the entire story. On May 26, a $1.29 billion block of IBIT was sold through what's called a dark pool, a private, off-exchange venue that hides order size from the public market until after execution. This was the largest dark pool Bitcoin ETF trade that top analysts at Galaxy Digital had ever observed. It pointed not to retail panic, but to a large institutional player quietly reducing exposure. May 2026 became the worst month of the year for Bitcoin ETFs, with $2.43 billion in net outflows. Year-to-date flows for 2026 turned negative for the first time. And here's where it gets complicated. Jane Street reportedly reduced its Bitcoin ETF holdings by roughly 70% in the first quarter of 2026. Goldman Sachs also trimmed exposure. Now, some analysts point out that outflow streaks like this have historically clustered near market lows, not the beginning of prolonged declines. During the February 2026 correction, a similar outflow pattern emerged near Bitcoin's local low around $60,000 before a recovery followed. But that history is not a guarantee. The question markets are asking right now is this a temporary washout or a structural shift in institutional demand? There's a third force weighing on Bitcoin that has nothing to do with Saylor or ETFs. It's geopolitics. U.S.-Iran tensions have been a persistent headwind for risk assets throughout 2026. U.S. airstrikes near the Strait of Hormuz, a critical choke point for global oil transport, sent shockwaves through financial markets. Oil prices surged. Gold approached record highs. And Bitcoin, which many called digital gold, didn't behave like gold at all. Instead, Bitcoin sold off alongside the Nasdaq. This is a critical observation. During the stress event, Bitcoin's correlation was with high beta tech stocks, not with the safe haven asset it's often compared to. On June 1st, news emerged that Iran had allegedly suspended peace talks with the United States. Bitcoin fell to an intraday low of $69,691, its weakest level since April 7th. Over 152,000 traders were liquidated in a 24-hour window. Total liquidations approached $744 million. The transmission mechanism here is straightforward. Geopolitical shock triggers risk-off positioning. Investors move out of high-beta assets, and right now, Bitcoin is considered a high-beta asset. Crude oil surges, capital rushes to safety, and Bitcoin takes the hit. The important nuance: analysts who track on-chain data say this is a speculative washout, not fundamental capitulation. Long-term holders, the so-called diamond hands, have largely remained inactive. The selling is coming from short-term traders and leveraged positions, not from people who bought Bitcoin years ago and believe in it long-term. So where does Bitcoin go from here? Let's look at what analysts are watching. The $70,000 level is the immediate line in the sand. Bitcoin has historically treated round numbers as contested support zones, and that level has psychological weight. As of Tuesday, June 2nd, Bitcoin briefly dipped to $69,700 before recovering above $70,000. If that level breaks convincingly, analysts point to $66,000 as the next meaningful support zone. Below that, $60,000 becomes the discussion, the level Bitcoin visited during the February 2026 correction. What could push Bitcoin back up? A few things. First, the upcoming U.S. jobs data, the ADP report, and the non-farm payrolls number. If those numbers come in soft, it increases the probability of Federal Reserve rate cuts. Lower rates are generally good for risk assets, including crypto. Second, a de-escalation of Middle East tensions. If the U.S.-Iran situation stabilizes, oil prices fall, and risk appetite returns across markets. Third, a return of ETF inflows. The Glassnode analysis of prior outflow streaks suggests that the heaviest selling often clusters near market lows. If that pattern holds, the worst of the ETF outflow pressure may already be behind us. The altcoin market has also been hit. Ethereum fell below $2,000. XRP dropped to $1.26. Solana declined to $79. The selling was broad and indiscriminate, a sign of fear-driven market conditions rather than targeted fundamental concerns. The crypto fear and greed index remained firmly in fear territory throughout this entire stretch. When fear is this widespread, historically, it has marked better buying opportunities than selling ones, though that is not investment advice, and timing the bottom in any market is extraordinarily difficult. Let's zoom out for a moment, because I think this story is bigger than one sale of 32 Bitcoin. What we witnessed this week is what happens when the narrative behind an asset gets tested. For years, the strategy narrative was airtight. Largest corporate Bitcoin holder in the world, never sells, buys every quarter, forever. That narrative attracted institutional capital. It sent a signal that gave others confidence. The moment that narrative cracked, even slightly, markets repriced the risk. This is how financial markets work. Prices don't just reflect fundamentals. They reflect stories. And when the story changes even a little, the price reacts, sometimes disproportionately. Is Bitcoin broken? The supply is still capped at 21 million coins. The network is still running. Institutional infrastructure, ETFs, custody, regulated markets, is more developed than it's ever been. The Clarity Act has improved the long-term regulatory picture in the U.S. But the easy part of the narrative, the one where Saylor never sells, institutions only buy, and Bitcoin only goes up, that part is over. What comes next requires a more nuanced analysis. And that's exactly what we're here to provide. So here's the bottom line from CapitalClarion. Strategy's sale of 32